The roller coaster ride continues that we've been on for the better part of the last 10 days, and we are unfortunately all becoming oil traders. The problem is that the real professional oil traders right now are not even confident on what they've relied upon in the past. Sentiment and positioning, that has given way to this dislocation where it is all about a very intense and complicated military operation. And we're seeing significant headlines. What that means for the oil trading community is that there is less participation. There is less volume. If you look at the average volume for spot crude oil at the end of February, it was 300,000 contracts per day. As we approached last weekend, it was up to 1 million contracts today. You got up to $119 Sunday night, and every day since, you're seeing the volume declining. So that is a very choppy environment to be in, unfortunately. Could we bleed lower? Yes. But remember, structurally, we're still in a bull market. We still sit about 1.5% above the 200-day moving average. And candidly, less is more right now. It's a moment to really just kind of step back, observe the environment, and allow this to unfortunately play out.
You could get out of a bull market pretty quickly if things go even more south than, some suggest they're already heading, certainly from an oil and energy standpoint and the fallout. Jonathan Krinsky of BTIG, as we come on the air, just publishes a note moments ago in which he says 6,550 to 6,600 on the S&P is now critical. Closing below 6,550 would suggest a meaningful top, with a downside measure towards 6,000. That was just published by Jonathan Krinsky of BTIG, in which he says losing patience, breath erosion, and financial weakness is just simply too much to ignore at this point. What do you think, Steph?
No, that doesn't make me feel good, but up until this point, we're only down.
You felt good before I read you the note?
Well, we're only down 2% on the S&P 500. Now, I know there's a lot of damage way worse underneath the S&P 500, but it is encouraging that it's holding up, and you are still continuing to see different kinds of rotations. Look, the markets do not like uncertainty, and a war is maximum pain. We have no idea the details. We have no idea how long it's going to last. We just don't know. Every day that there could be a new development, a new tweet for all we know, right? On the negative side, clearly oil prices are, it's worrisome to see the velocity of the move. But when you think about it at the pump, right now you're at $3.60 at the pump. That's actually at levels seen back in 2022 and 2023. Thanks, Brian Sullivan, for pointing that out earlier this morning. It's not demand destruction at 360 yet. So obviously that's why we're waiting. Now, that's kind of the negative and the uneasiness. And I'm also not crazy about bond yields keeping on the upside. But on the positive side, Scott, the data in the economy is actually all right. It's pretty good. The Atlanta Fed tracker, I know I probably just stole your thunder, Jimmy, but it's at 2.7%. Everyone was panicked on the non-farm payroll numbers on Friday, and we got great initial claims this morning. And also, retail sales have been good. Look at Costco. Look at Dick's. Look at Walmart.
I just feel like all of those metrics, granted, they're all good. They're all almost meaningless because they're
productivity is the thing I was about to say, and that's not. No, and productivity is and productivity is not backward looking.
I'm not talking about productivity.
But that's what I was going to add as my fourth and final point. Maybe these other things change, certainly, but right now, the numbers are the numbers, and productivity is a very big positive, and that's a nice tailwind, an offset. And one last thing, one big beautiful bill has yet to hit, and that will help in terms of a little bit of the oil price, maybe the inflationary pressures.
I'm sorry to interrupt Jimmy and Josh. I agree with everything you're saying fundamentally. To me, where we are in the moment, can you secure the Strait of Hormuz or not? That's what everything boils down to. And if we can't, then this punitive environment continues. And if we're able to secure it, then we're going higher.
Okay, to that point, it's binary. Obviously, the market is reacting to that, to which JP Morgan's trading desk is making a tactically bearish call this morning. Long energy and energy stocks and short equities. It's really that simple. They say, quote, if we get to a Sunday when futures open without a resolution, we think risk assets will see a more aggressive sell-off. I urge you to go to CNBC Pro, subscribe, and you'll be able to read more stuff like that because there's a complete write-through on what JP Morgan's trading desk is saying about how to approach this market from a tactical standpoint. It matches with what Joe says. This is a binary issue. Straight open, stocks up. Straight closed, stocks in trouble.
It is a binary issue, Scott. I agree. However, there is another dimension to it, which is time. How long does this last? The longer it goes, the more significant damage will be done. The president has said it's a 4-week operation. If that's the case, and the straits are opened in the next 2 weeks, I think while there will be damage to profit margins and profit growth, it will be temporary in nature.
We can even stop with the 4 or 5 week, month, this, that, because the messaging has been so inconsistent. Because this morning it was we're going to stay there until their defeat as long as it takes. So
the reason
if you're going to hang your hat on,
no.
It's going to be 4 or 5 days, or now 4 or 5 weeks, or 4 or 5 months. Good luck.
Yeah, so I agree with you that the messaging has changed day by day, if not more frequently. But what I'm saying is I haven't changed my stance, which is to be invested in a broadly diversified equity portfolio. So I'm not taking the J.P. Morgan advice, not yet. And the reason is because of what you're saying, Scott, because of what you're saying, Joe, that if the straits are opened tomorrow or a week from now or 2 weeks from now, I don't think enough damage will be done to upset the significant positive forces in the economy and the markets, whether it's stimulus from the budget bill, whether it's artificial intelligence, capital expenditures. The straits being closed will leave a mark, but it will not be fatal if it's opened by the end of this week. And I do want to point out one thing regarding oil, that there are cushions involved here. We have to remember, before this started, there was a very significant surplus of supply over demand. And it's not, it's a matter of time before the Baker Hughes rig index starts to creep up, particularly here in the U.S. That has been very moribund for years.
As long as it's open by the end of this week. You realize today's Thursday.
No, I'm sorry if I misspoke. I meant by the end of the month.
Okay.
By the end of the month. Thank you. Let me be very clear. By the end of the month.
Okay. So, Josh, B of A today in their commentary is, obviously about risks to the macro. And that's really what this whole story boils down to, in which they say we think markets could be underpricing the odds of a synchronized global slowdown. In the emerging markets, positioning is now much cleaner and interesting opportunities have emerged. That's consistent to where people have thought there were better opportunities anyway in the emerging markets rather than in the U.S. market for a variety of issues. We don't need to really go there at this point, I don't think, but the idea of the markets underpricing a scenario in which you have a synchronized global slowdown.
Yeah, look, I think the big picture here is that I can't remember a time where the S&P has been as close to an all-time high as we are now with as little conviction as we're seeing. It's really a remarkable thing, and I think the rotation is the reason why that's even been possible. So the problem that we have is that the stocks that are working are under-owned and not large enough to accommodate the people that want to be on the right side of the trade. And the stocks that are really important are just not working. And so when you think about energy, far and away the biggest winning sector on the year, up 27% year to date. I, of course, have been talking relentlessly about ExxonMobil, which, again, is making a high now. But there are a few of these stocks. There aren't 100 like there are in the software group or the semiconductor group. There's just a few. And then you have to dip down into small caps. And that's sort of problematic for the market. The other thing is we have this slow motion negative news cycle, which is now becoming a negative price cycle in private equity. Very quietly, the XLF is in a 13% drawdown. That is very negative.
I don't even know if it's very quietly, to be honest with you. I don't know if it's all that quiet. We've been talking about it
for
a
some
lot,
stocks,
and it's been screaming. It's been screaming for a while that, hey, if the financials continue to have, I've said this numerous times, and we've discussed it with numerous guests. If the financials continue to have an issue, you're going to have a really hard time getting this market to have some stability and durability again.
Well, you had a negative labor report that missed expectations, and now you have Bank of America in a 17% drawdown. The credit cards, Synchrony Financial down 28%, Capital One down 31%, and once again, the jobs numbers are now surprising negatively. Not great. The XLF is in a drawdown almost as bad as the Liberation Day drawdown, which was 16%. So we're down 13. We're almost there. And then, of course, you've got the PE/PC segment of financials, which are at this point now in 50%, 50 or greater drawdowns. And now with JP Morgan starting to mark down the assets it's lending against to these private credit firms, it's almost like a self-fulfilling thing where the news cycle is bad, which prompts even more redemptions, which makes the news cycle worse, which worsens the redemptions. I really don't think that stabilizes on its own. So I know we're talking about crude, and I know we're talking about the Strait of Hormuz, but guys, if that were resolved tomorrow, that doesn't change the bigger issue that we have here, which is that lack of conviction. Last thing, here's what nimble traders are doing. I'm going to give you a couple of tickers. Throw these charts up for me. Here's another Hormuz-related supply disruption, this time in the materials space. Look at these rallies. CF, plus 13%. Mosaic, MOS, plus 10%. Dow Chemical, plus 8%. Lyondell, plus 7%. So traders are looking for opportunity from the Strait of Hormuz being closed down, and these stocks are going parabolic. But again, they're not big enough to offset the negatives.
No, but opportunity finds itself in times of upset, as we've learned.
Well, here it is.
Joe, you the first day of the war, I think you bought CF.
Sure.
It was the first place I think you went in looking for stocks that may have an opportunity to go up on the headlines and the events of taking place in the Middle East.
So
let's talk about that for a minute.
The Iranians are significant exporters of urea. Nitrogen, it's not negotiable, it's mandatory in corn planting, and CF had a 7% short interest on March 1st. That was one of the things that I found so compelling. A very cheap valuation, to Josh's point, 75% revenue growth. So it is one of the first places I went. I bought it at 104. I'm going to be fully candid on something. I do not know.
You're suggesting you're not usually?
What to do with the position right now. So I'm maintaining, I'm holding the position, I'm raising the stop.
Okay.
But again, it's binary. If the Strait of Hormuz is secured, CF Industries is going down 10%. I know that. So you could say, okay, I'll sell a little. I'm not so sure I want to do it. So really, only thing I'm doing right now is trailing the stop, but it is directly related
That's what I would
to
do.
the war.